Hi, I'm Finucane, Chief Investment Officer at Oxbow Advisors. The stock market is up slightly to start 2025, but there's a lot moving under the surface. Here's what we're watching closely. The Magnificent Seven tech stocks are no longer driving most of the S&P 500 index return. In the first 2 months of 2023, the Mag 7 stocks appreciated by more than 30%. In the first 2 months of 2024, they appreciated by nearly 20%. But to start this year, they are down nearly 5%. We think this is going to be a choppy year for stocks, and the Mag 7 facing more resistance is a big part of that. It's worth noting that the rest of the large cap stock universe is not cheap either. Many have noted that the 10 largest stocks in the S&P 500 trade at nearly 30 times earnings. What's equally important is to recognize the other 490 stocks in the index trade at 20 times earnings. If you look at this 40-year valuation chart of the S&P 500, it's only at around the dot-com bubble era and the 2021 market highs that the rest of the large cap stocks were this highly valued. That makes it even more crucial to be aware of the price you're paying for any stock and the downside risk if the economy weakens. We just completed a year with high returns and minimal volatility for the stock market. That rarely repeats for another year. The Sharpe ratio measures the return of the stock market divided by the volatility of the market. When the ratio is high, it means returns were good while investors did not have to face much volatility. 2024 was a high Sharpe ratio year like 2017 and 2021. What's notable is how difficult it is for the market to stay this accommodating to stock investors in the subsequent year. 2018 and 2022 were bear market years with much higher volatility. We think 2025 will also feature lower returns and high volatility. Our first 3 slides focused on large cap stocks. What about small cap stocks? After the November presidential election, the small cap indices rallied more than 10% within a couple of weeks. Investors forecasted a more positive environment for smaller businesses in the years ahead. That's now reversed to the point that the Russell 2000 index is down 11% in the past 3 months. Uncertainty has increased due to all the new policy and trade announcements. It's hard for business managers to plan years ahead when it's unclear what the underlying environment and rules are going to be. These are also lower profit margin businesses that are more reliant on a healthy, steady economy for their growth. There will be an opportunity to become positive about investing in small cap stocks again, but today we think it's better for the vast majority of one's stock portfolio to be in reasonably priced, large cap stocks with higher profit margins. Those businesses can better withstand the economic fluctuations ahead. We are seeing some issues in cyclical sectors of the market as well. Transport stocks are in a correction, and the home builders are really showing weakness. Home building stocks have declined by more than 30% from their highs last year. Building product stocks that supply the home builders are down a similar amount too. This decline has brought their share prices back to about fair value when compared to the cash flow they're currently generating. What we are watching closely is the 30 to 40% downside that remains if these stocks fall like they have numerous times in the past decade. If another leg to this decline begins, it could suggest broader weakness in the economy that is not being considered. Last month, we discussed the inflation rate in the United States and how it's been accelerating since September. But the United States is not the only part of the world where inflation has been sticky. Amazingly, Japan's inflation rate just hit 4%, which is significantly higher than the US or Europe. The last time that happened was over 50 years ago. As of now, international growth and inflation appear set to increase in 2025 after a stagnant 2024 for some major overseas economies like Europe, the United Kingdom, China, and Japan. Acceleration overseas likely means higher commodity prices, so we are keeping our exposure to commodities in our high-income strategy. Higher inflation abroad also could mean stronger international currencies and a weaker US dollar, which also bodes well for US investors in commodity-exposed businesses. Things can change quickly in the economy and the world of commodity prices, but these data points are telling us to keep the commodity positions we've added over the past few years. We hope that gives you a sense of what we're following in the markets today. If you have any questions or would like to learn more about Oxbow, please contact us. We like to provide the information we think is most valuable to investors. If you'd like to see more of our insights, please subscribe to our YouTube channel.